All right, you all. Okay, well, we have a very diverse group here today. So with very, very different stages in each of your individual enterprises, which is great. So we're going to try and cover all of those different stages, because although they are different, there are strong themes that run through all of this. So did that work? Okay. So, all right, we're going to talk about goals. We're going to talk about some of the tools that we use. We're going to talk about things that affect what we do financially. And I'm going to talk a lot about the mindset of the entrepreneur. So today we're going to do a bit of a deep dive into all things related to forecasting, money management, these mysterious things we refer to as financial statements, and this thing that we have to do every year called a year end. But I'm also going to weave that in with how we develop KPIs, because none of these financial tools operate in a vacuum. So what I'm going to do today is to bring that all together. And my goal is that when we leave today, after today's session, that we'll have a better understanding of how we integrate all of these tools to make our enterprises more successful going forward. Okay, I'm going to start with an umbrella statement, and I'm going to say there are no right and wrong ways to do this. And you as founders and you as entrepreneurs, you provide the vision and the mission that's going to take your enterprise forward. And a lot of what we're going to do here today needs to be a reflection of the authentic you and the way that you want to move your business forward. So, but to begin with, what I'm going to do is just to go over the nuts and bolts of the tools. And I'm going to make sure that we're on a level playing field, that everybody understands what we're talking about here and really why we do them, right? So, and as I say to everybody when I stick up the agenda, I don't stick to it anyway. So forgive me, but I know that we'll go off on tangents. So what have I got here? All right. So we're going to talk, as I said today, not only about these mysterious things called financial statements. I know that you need to hear this, yes. But also what we do with them, because all they are really is just a set of tools, right? It tends to be something that we delegate to our accountants at the end of the year, just to get into compliance. I'm seeing nods. I know that some of you are nodding over there too online. But really it is an extremely valuable tool that we can use in our arsenal to build our business. So I'm going to do a deep dive into what they are. We call them financial statements, but actually they're just management reports. And they are a suite of 3 different reports. And we're going to talk about what that means. I'm also going to talk about forecasting. Erin, how useful is forecasting? Say the right thing for me now.
It's game changing. I'm literally using it to help us refinance for a loan today because I'm able to show what I've been able to track over time and how close I am, how much I understand my business is easily communicated through our forecast.
Yeah, okay. So thank you very much, you're a darling. So we're going to talk about forecasting and why we do it. And I've got a number of different stories that I could tell around that. And Erin, I'm going to lean on you because you're one of the persons in the room that we've really done a deep dive and we've made it work within your organization. Then I'm going to talk about KPIs. So what the heck are they? Anyone any idea KPIs? Right, but what's that mean? Does anybody have any? I know Aaron does again. KPIs. Yeah, we
Don't beat me.
beat you.
Yeah.
So we use these buzzwords, right? Key performance indicators. What the heck does that mean? We're going to break that down and we're going to say, okay, well, you know, what are they exactly? But how can we make them useful to us? So because we are a small group here and you guys online as well, interrupt me, okay? So if there's something I say that doesn't make sense, just interrupt me. So, okay, where am I going now? Management reports. We're going to start there with those mysterious things called financial statements. And as I mentioned, what they are is actually a suite of management reports that constitute 3 different reports that we've got up here. So this really is the nuts and bolts of how your business is doing. And you notice that I'm using here the past tense, because these reports all tell you how you did. It is a rear view mirror reporting system, okay? All it's done is it's collected data over a specific period of time, and it gives you a snapshot of how you are doing today. How useful is that in telling you what you're going to do tomorrow? It's a question. Well, it can be very useful, or it might not be useful at all. And sometimes I do find that people can get a little bit mired in the past tense of their business, and that creates sometimes an inability to look to the future. So I always say to everybody, never allow where you are today to impact where you're going tomorrow. So we need to absolutely learn from where we've been in the past. And this is the suite of reports around that. So what the heck are they? By far, the report that you will use the most, I hope, after today's session, is your income statement. Sometimes referred to as a profit and loss statement. Same report. You will find that these accounting folk, and we don't have any accounting folk here today, so we can say what we like about them. You will find that these accounting folk tend to try and make it more complicated than it actually is. So what the heck is this income statement? Well, very much as the name suggests, it is simply a report that tells you about the income you've earned, right? How do we look at that income? We look at the gross sales you have made, or in terms of you folk that are pre-revenue and you're looking for investment capital, revenue can also take the form of investments raised. All right. So as a founder and a CEO, what is your primary function in your job? That's a question, it's not a trick question. Come on, somebody give me an answer.
Positive income.
Yes, it really is. Now, I know you've got a chief financial officer and we can take a, you don't, okay. You probably need one. And we can take a dive down that a little bit later, but frankly, the main responsibility of a CEO in a business is to make sure you've got enough revenue coming in that the business is going to thrive and survive. Because at the end of the day, whether you're looking after if you're not looking after this top line, the revenue coming in, the sales or the investment capital, you don't have enough money to operate with, right? So this particular report gives you a snapshot of that, and it is always over a period of time. So you want to say, let me look at my income last month. Let me look at my income last quarter. Let me look at my income last year. And you might also do some comparison studies. What is my income last month compared to the same month last year? All of these things you can look at. Why do we do that? Because we want to try and look at some trend analysis. But at the end of the day, this is a snapshot in the rear view mirror. It only tells you what you did do, not what you're going to do. There are 3 very critical lines on this report that you need to understand inside and out. You don't really need to understand the rest at this stage. So if we leave here understanding those 3 very critical lines, then we're really a ways ahead. And I'm going to talk to you about the food business. Okay, because you're a little bit unique in this group here, because you're considering that, and that's really a wild card. All right, so we know that the first one is the sales, your gross revenue, how much is coming in or how much is coming in investment. The next one here that you see is net revenue, sometimes called gross profit. It's the same thing. So like I said, these accounting folk like to take several yards. Same thing. What is it? Very simply, what that is, gross profit or net revenue, is the money you have left over to run your business after you have paid for the cost of the goods you provide, for the goods or the service. So let's take a very simple idea here. Let's say that we are in the consulting business, right? So, and that's about as simple a business as you can look at from this point of view. So my gross income is all the money that I earn from the different folks that I help and the different organizations that I work with. My cost of doing business is my time and my labor in providing that service. Why is that the cost of doing business, you might ask? Because I only spend that amount of money if I've got a sale. And that's the important delineator that all of you need to know. It's your cost of goods sold, whether you're making a good or whether you're delivering a service. If you don't spend that money, if you don't make a sale, then it does not belong in that cost of sales, all right? So here's what we want to do. We want to separate all of the cost that you have that's associated with producing your good or your service. So we come up with this magical middle line, often referred to by those accounting folk again as the line, which is your net revenue gross profit line. Why is that so important? I'll tell you why. Because I would say in 80% of the businesses that I work with, that are over 100 businesses I've worked with in the last 4 years, the problems that folk run into are above that magical line and not below. So it's the cost of goods sold, the cost of production, the cost of manufacturing, the cost of delivering the service is where the devil is in the detail. Why is it so important? Because what you're left over with after you've paid for that is what you've got left to run your business. If you don't have enough left over, you can't run the rest of your business. So knowing that ratio, understanding your costs that go in there above the line is extraordinarily critical to what you do. All right, so I do a lot of work in the venture space and I do a lot of work in the exit space. So let me give you some rule of thumb around this. If your business is operating at below 40% at the gross profit or the net revenue level, same thing, it is considered by external funders to be a commodity business and they are not interested in funding you. All right? Now think about that. If you're going to go into a business, aren't you better to go into a business where you know that you can control your cost of manufacturing or your cost of delivery and you have a healthy amount left over to run your business? So Carl, because Carl and I were in very similar businesses, I used to get 65%. What are you getting? So, all joking apart, no, I wasn't really joking. All joking apart, I would say to you that if you can't at least end up with 50% of your revenue on the gross profit margin level, really think about the model that you're in. And I'm saying this for you because before you go into the food production business, I'm going to run some figures for you. That is about the most lethal business that I've come across in my experience to go into in terms of profit margins. And particularly, just saying, I'd rather tell you now, just saying, and particularly for those that want to go the route of becoming a national brand and going through retail channels and what else. They call it a high volume, low margin business for a reason. And I have clients that are operating on 8%. So for every $100 they get in sales, they've got $8 left to run their business. Does not go very far. So this is really something to consider. So that to me, that gross profit, that net revenue line is one of the most important that you as a founder need to know intimately. Because all you've got below that is just your list of expenses. And frankly, they are easy to control. There's your labor expenses, there's your accounting expenses, your bank charges, your insurance, your advertising promotion, digital marketing, all it's stuff, right? You know what it is, we call most of them variable expenses, but really they're pretty static from month to month. So unless you're doing something that's really a 360 in your business, they're not going to change much. You might, if you're going into tight times, reduce and reduce and reduce those expenses as much as you possibly can, because you want to run a meeting machine. But at the end of the day, they are what they are, and they don't take a lot of managing. Whereas the cost of manufacturing and the cost of producing your good does take management. Okay, so all that said, what we want to make sure that we end up with on that bottom line, after we've paid all of our monthly expenses, is a profit. And I can't stress this enough. And certainly as startups, pre-revenue organizations, you're going to know what your monthly burn is, right? But we want to get towards that profit position as quickly as humanly possible. And Adam's there on the call, and he knows we see a tremendous amount of businesses looking for SOFI financing that are forecasting that they're not going to hit a break even, perhaps out 2, 3, 4, 5 years. And I would position to you that in the vast majority of cases that is not necessary, and that you're burning through unnecessary capital, but that's probably a chat for another day. So, all right, so what this document tells you in a given period of time is whether or not you are making money on day-to-day operations. Anybody got any questions around that? I have this deathly silence. I have that in effect on people anyway. So, all right, so that is one of those reports that I'm guessing that some of you don't look at from one year to the next. I would suggest to you that we should look at that at the end of every month. After you've made sure that all of the sales and all of the expenses are accurately in that document, I would have a look at it. So because it tells you, did I lose money? Did I make money? Pretty critical. All right, what's the other thing that you've got in that suite of accounts? A balance sheet. Right. We all know what a balance sheet is, don't we? So it's exactly the same thing that if you go to your high street bank and say to them, I want to borrow some money, I want to buy a property, they're going to look at your assets and your liabilities. A business has exactly the same list, has exactly the same report. It's called the balance sheet. Why is it called the balance sheet? Because we want the assets and the liabilities to be in balance with one another, right? So all it simply does, and normally you see these things sort of more landscape, all it simply does is it looks at your current assets, which you'll often find reported on the left-hand side of the sheet, and your current liabilities. And it says, all right, then, here's your asset test. Between how much you actually own and how much you actually owe, what's the difference? In other words, are you in a negative position? You owe a lot more than you own, or are you in a positive position? Why is that important? It's important from a borrowing standpoint, and it's important from a liquidity standpoint. So I'll tell you some stories about balance sheets as we go along, which will perhaps make it a little bit clearer. Once your enterprise is up and running and you're in a position that you've gone through your startup stage, you're perhaps into scale up, but you're self-finance, then my rule of thumb around this is that I always want to have assets which are twice the amount of debt I have. 3 times is a beaut. Why is 3 times a beaut? because then when I, as an entrepreneur, go to the investment review committee with Adam here, and I say, I'd like to borrow 500,000, and they pull up my balance sheet, they say all kinds of liquidity here. There's lots here to borrow against. There is absolutely no problem servicing this debt, rubber stamp. So I would also give you a little word there too, as you get to this stage. Always, when you've had a super duper year and your balance sheet and income statement is looking great and that reflects in your cash flow, go to your friendly banker and ask them for an increase in your line of credit. Always do that when you don't need one, because you will need it at some stage and then you won't get it. So, all righty, so balance sheet. The next document in that suite that we call financial statements is your cash flow statement. What the heck is that? You folks that are in investment mode and you're pre-startup, you know what that is intimately. That tells you how much money you've got left over, hopefully, at the end of every month after you've paid your burn and everything else associated with getting your enterprise off the ground. That's your lifeblood, right? So as I said, that really the keys in terms of successful entrepreneurship are managing that bottom line, that top line. It's because it reflects here in your cash flow. So if you're not generating enough revenue, albeit through investment or through sales, then you end up with a cash flow statement that's in the negative. All of that does, very simply, it says, how much money did you start off with at the beginning of the month? What are your expenses in the course of the month? How much money have you got coming in? And now where's your balance? That's all it is. So these three documents really tell you the financial health of your enterprise, and they are absolutely something that you should look at on a monthly basis. So for those of you who said, I don't have a chief financial officer yet, when you get to the stage that you do, these are the kinds of discussions around these reports that you would have. All right, any questions on that? If I go around the room and ask if it was understandable, would I get affirmative nods? All right. What we got next? Yeah, you're a doll, thank you. I am useless at tech. All I've got to do is look at it and it stops. Don't laugh, it's true. Yes.
How can I end a year in a negative number and still have physical money in my bank account? How does that make sense?
Isn't that an excellent question? Okay, because there is a lag time between when your accounting posts on your income statement and when you collect money. There is also a lag time between the money that you get in and the money that you're paying out. So if you are, and I don't want to get too technical, but if you are following an accrued accounting system, which means you're registering the sales or the revenue in and the revenue out at the time you make the purchase or at the time you send your invoice, that's different to when the money comes in, right? Or when the money goes out. Ta-da! So, okay, yeah, yes. This is why you need to be looking at these things and this is why we're going to forecast, because the vast majority of new startups and entrepreneurs that I work with do confuse that, and they run their business out of their bank account and they say, well, I've got money in my bank account, so I'm fine. Not understanding that there's a whole slew of money's got to just come out, right? And that can really run you into trouble. So there is a difference. There is a lag time between when you post your invoice, your revenue's coming in, when you post your expenses, your revenue's going out, and when the transaction actually hits your bank account. Now then, in a business like my old business, we used to do a lot of civil project work. that asked me about the LaSalle Causeway Bridge one day. We would do jobs like that, and sometimes our milestone payments could be 12 months out, right? But we have spent a tremendous amount of money in a build or whatever we're doing in order to get to that point that we've got some milestone payments coming in. So we might have invoiced these guys in 2023. We're not going to see anything for a year. So really, really important that you're able to capture this information. Does that help?
Yes, but.
I'm
how
going to
would-
cut you off from looking at your bank account. I'm just going to make you do it on the forms.
Oh, God.
But
Yes, but, so the way to get a realistic, the line is to anticipate what's gonna go out and create bills in your
your
QuickBooks
cash
account.
flow forecast is going to give you that.
But how would it know if I don't tell it?
It won't know
Right.
if you don't tell it. So really, that's what we're going to talk about. We're going to talk about forecasting, right? And why we do it. And the big reason we do it is so we don't just operate out of our bank account and do. How many people here like worrying at 2 a.m? Not so much, eh?
At 12.
Oh, okay. 3 was not my normal time of preference. And how many people are just really looking forward to that day that their bookkeeper comes to them and says, we can't make payroll. Whoa. Okay, if you do this, and if we forecast and we do cash flow forecast, then we can avoid that. So we can avoid it. You know what? People hate doing it because they don't like bad news, but wouldn't you like bad news you can manage than it hitting you over the head one morning? Yeah, right. Okay. Any more questions?
No.
All right, where are we at? Ah, this thing. This is Erin's favorite document. So first of all, before we even sort of dive into that, can somebody tell me what is a financial forecast? Not you, Erin.
Forecasting your expenses and forecasting your revenue.
Okay, why do we do it? And don't tell me because you have to do it for your investors.
Just planning for future.
Yeah.
Yeah.
Yeah, it's about risk management and it's about growth and development, right? Now then, here's when we talked right at the beginning and I said that your vision and mission really overlies all of this. And Ratty in her introduction of herself said it right on the nose. So what is the founder's vision and mission dictates how you're going to forecast. So Ratty said something very, very interesting that I'd concur with. She's at a stage in her enterprise where she's got to decide, does she take on a slew of other engineers? I know that Rat has a design department in India that she outsources to. Does she develop that? Does she develop that revenue source of design work? Or does she enjoy the good life and not have to worry about having all of those resources and trying to keep control of all of those people?
Yes.
Okay, that's a very legitimate question. And there is not a right or wrong answer to that question. The right answer is it doesn't matter as long as your enterprise at the end of the day is going to make money because you're going to be satisfied. So whether you have a multi-million-dollar enterprise with a C-suite of executives reporting into you on a global outreach platform, or whether you want to stay local and you want to stay within your vertical, it doesn't matter. It's up to you as a founder to decide that. So when you're looking at your forecast and what you're going to do in the future, that's your vision that you're putting down there. So don't think of it in the beginning. Make sure that you're framing this right as a bunch of numbers. Think of it as, where do I want to be at the end of next financial year? What does this look like? What will make me satisfied? Will that mean that my business is going in the right direction for me? And there are all kinds of considerations around that. Lifestyle, your own personal ambitions, these things can change through time. You know, we all, I hope, have a private life. And sometimes that private life dictates the balance in terms of the amount of time and resources we can put into our business and our family requirements. So these things are going to change through time. So be really cautious that when you're doing this, you're not doing it just as a numbers exercise, as something that you need to do to satisfy your potential borrowers, but as something that's really important and at the core of what you're building here. So what do? Here's what I do, and I can split this out dependent on the type of business you're in. I have given you an example here of a forecast in the National Food Startup business, okay? And I have looked at this by quarter. Why did I do it by quarter? Because it fit on the spreadsheet more easily than by month. That's the truth. How you do it depends on the business you're in, okay? But what you want to do is capture the time periods that make sense for your business. Some businesses are what I would call a daily newspaper. That means that how they generate business day in, day out, day in, day out is pretty much a 24/7 thing. And you need to understand those fluctuations in that shorter time frame. So you might have to look at that shorter time frame. Some businesses are monthly, and I would say that 80% of businesses look at their stuff on a monthly basis, and that gives them an adequate understanding of where they're going. And some businesses, frankly, are quarterly because they offer services or produce product that have a very long lead time. So really, you're only seeing the rolling effect of that on a quarterly basis. How you do that's up to you. Okay, but what do? I plot where I think my revenue is going to go. How do I do that? You'll see in that blue section there, I have a look at, what we did do the prior year. So looking back has its value because that's your reality of where you came from. So unless something has radically changed, the likelihood is that your next year is going to look quite a lot like your last year, unless you're making major changes, okay? And then I project over the period of time what I think that's going to look like. And you'll see up there, I've said streams 1, 2, 3. You might have 20 revenue streams up there. Why do I break out these revenue streams separately? Because you will find that the different streams in your business produce very different profit levels. And you might be selling stuff in your business or rendering services that lose money. You need to know about that. I see that a lot. And don't let me on a rant about QuickBooks Online. It's not really QuickBooks' fault, it's how they get set up. It is very, very critical that when you set up your accounting, that you break out your revenue streams accurately. So you know what money you're deriving. So I'm picking on you again, Raz, but it's a very good example for you from your engineered services or your design services. And you need to clearly separate them out because they're two separate revenue streams, right? Now then, after I have done that, what I also do is I look at each of those individual revenue streams and I say, what is my cost of goods sold in each of those revenue streams? So that could include, I've got up here, the cost of buying the goods that is integrated into that, packaging, freight, going to come back to NCBs just for you. All of those costs that are associated with that. And I want to know by each of those revenue streams what those costs are. Because for each of those revenue streams, I need to know what the profit margin is. So that net revenue or gross profit. Why? Because I have seen so many times folks offering revenue streams that actually lose money. Because they lump it all in together and they say, well, all in all, my gross profit's about 50%, so we're doing fine. But what if I could say, I'm going to reduce your sales by X amount a year, but your profit's going to go up by Y? Because we're just simply going to either stop producing a certain good or service, or we're going to reprice it, or we're going to rejig our cost of goods and all of those things in there. So that is really, really key. Then obviously I look at the operating expenses and I come up with my profitability or lack thereof here. Yes.
Does the cost of equipment go into cost of goods?
Are you talking about
Capital expenditure?
No, your capital expense budget is separate
Okay.
and it would be amortized or depreciated into your budgets. And you would see that reflected on your balance sheet because there's a capital asset that you own. Okay. The expense of carrying it would be in your expenses. You could hypothetically put it into your cost of it, all right, but you put anything you want into cost of sales. Don't let anybody tell you that these accounting systems, and they do follow accounting practice, but it's up to you what you put in there. One of the differences that people very often make is whether or not they put the cost of labor into cost of sales. So if you're, have a certain number of people that are producing X, do you put it into cost of sales or do you show it below the line as an expense? I always actually used to expense it. The reason I used to expense it, even though the majority of our people were revenue generating, is because it was so brutally hard from a cost accounting point of view to allocate it accurately, that the price of perfection was too high for the result I was going to get. And I tend to be pretty accurate about how I keep this stuff. But if at the end of the day, your judgment says, well, keeping track of all of that is just way too high for the benefit I've got, then I would just expense it below the line. So they are decisions that you have. However, you then know that, right, when you're looking at the figures, so you factor that in. So, okay, so that is critical. Now then, talk to Rick about this while we were waiting for everybody to join. I have to watch my time here, because I do like to talk. So, it doesn't matter what stage of business you're at. You want to aim to run your business at the best in class for the sector that you're in. What the heck does that mean? All right, let me tell you what it means. So there are all kinds of statistics available for those of you who do business with BDC. They will give you the industry statistics for your business that tell you that within your sector, these ratios that we're talking about today, these are the benchmarks within your industry. So all those folks out there, how well are they doing? And then you want to say, how do I stack up against the very best? And usually what these statistics give you is quadrants of the very best guys in your sector, the middle of the road, and the also-rans. Always budget your business, always operate your business to be in the highest percentile. Why? Why wouldn't you? I can think of no reason why you wouldn't benchmark yourself against the best there is in the industry. Now, what happens to your enterprise if you're continuously operating as the best in your industry? I'll tell you. You're making loads of money. You can exit your business pretty well when you want to, because there might even be people knocking on the door because they've heard about how well your business operates. You can grow, you can go into another sector, you can go to your friendly banker, or you can talk to Adam and I. You can raise capital. It's because everybody will look at those figures that we talked about earlier, and they'll go, wow. So let me tell you when I knew I'd made it in my business. So it was a year end, and it was actually my BDC rep who was doing her annual meeting with our business, and I was talking about some expansion plans that we had, and she and I were good friends. So, it sort of puts a bit of a different slant on it. We were very good friends. And she said, okay, she said, show me your balance sheet. So I just reached over and I said, press, current balance sheet.
And I gave her the rolled up version and she looked at it, she said, that is a pretty balance sheet. End of story, we will fund it. So why would you not always strive to be? Because it opens so many doors for you. Now then, the reality is that most businesses are on their way up, so they operate in that middle level. If you're operating that lower quotient, we need help. We need help on the business model because something's not quite working right. Okay, so why do I do that? Because of that then extrapolates into my cash flow analysis. So once I've tracked out the money I think I've got coming in and the money I think I've got going out, that will actually plot for me what my cash flow is looking like on a month-to-month basis, my operating funds, my working capital. And that will tell me whether I need an infusion of cash or whether I'm just great and I can operate out of working capital. So that answers your question, why do we do it, where do these figures come from? It comes from the forecast we're doing. And when we're looking at enterprises that are wanting to raise capital, we're really looking at 5-year forecasts going out. Because those folk that are evaluating that enterprise, they want to say, where's this enterprise going? What kind of cash is it going to generate? So they're looking at return on their investment and all of those things. But never mind, if you're just a person running your own business, you still need to know that stuff. Okay. All right. Next.
It's not, yeah, it's tired. There we go. Okay, all right. So we have talked a little bit about the financial statements, the suite of 3 different reports. We've talked a little bit about forecasting. We're going to talk a little bit about KPIs. I just remembered something about forecasting. So I'm going to go back to that, talk a bit more about that. All right. I am awful with the people I work with directly on a regular basis about forecasting. Do you know what I make you do? I make you do the forecast for starters. And I usually make you do it per month. Oh God. Won't help you now. And then do you know what I make you do? I make you close your month end, so all of the expenses and revenue are in there. And then I go to that spreadsheet and I say, just drop me in a column there, will you? And input your actual figures next to your month end forecast. And then open me up another column and just extrapolate onto that your variance. And now give me a report about your variance. I want to know line item by line item why your forecast and your actual were not the same. All right, why do I do that? Am I trying to catch anybody out? No. Are they ever the same?
No.
No. So why do I do it? Have you heard those folk that say to you, oh, you know, I know my business so well, I instinctively know what's going to happen. I'm going to call BS. You know what they know? They know their business so intimately that they know what's going to happen. Now, they might have gone to the stage that they're, what is it, in unconscious competence. So they've been doing it for so many years that yes, it feels like instinct, but it's not. The reason that we do that, and the reason that I advocate very strongly that when you're in your startup years that you do that, is because it's not the math of doing it that's important. I want you to understand intimately what changed in every month and why. So if your sales were way over your total, why? Did you just onboard a fabulous new client that you hadn't anticipated? What do you do around that? Does that mean that your forecasting going forward needs adjusting because now you need more resources? Or if you're seeing a steady decline in your top line, why is that? If your expenses are going up or your cost of manufacturing is going up, why is that? The only reason that I make you do that is because I want you to do a deep dive into why is that? Because I want you to intimately understand what impacts your business. If you do that month in, month out for a year, I will tell you that at the end of that year, you'll be one of those folk that says to me, oh, I instinctively understand the business. So it's always, whenever we forecast or we do marketing plans or strategic plans or whatever, it's never about the plan or the spreadsheet. Isn't it pretty? Isn't it wonderful? It's all about the questions it forces you as a founder to ask. It's all about the what if questions of understanding your business at a granular level. So that's why I do it. Erin, can you unmute, please? Does it work? Is she there?
Hi, I am there. Sorry, I had to capture the dog. It does work. It does work.
Yeah.
And not only that, it's a really great way by which to have conversations with business partners about what's actually happening in the business, because it takes some of the emotionality out of it and you're just looking at the numbers. And because we now make this a part of our monthly practice, at a moment's glance, I could say at any given time, we know where we stand, we know what we're doing, and we're able to track changes really easily. And I've added extra lines at the bottom for our KPIs because I wanted one document that would easily snapshot what made a difference and what we're expecting to make a difference. So it's been invaluable, especially when you've got partners. It's hard sometimes to have a conversation that doesn't get overly emotional. And because this happens every month and you've all contributed to what you thought the forecast would be, when it's not that, having that explanation of variable means that you can think about it in a concrete way without having big reactions. So we will never stop doing the monthly, I don't think, until we're making so much money that it just, I don't know. I don't know when we stop doing it, but I don't see a compelling reason not to do it, make it a part of our monthly practice.
I agree. Until it's all instinctive, right, Erin? You just know. Okay, thank you very much. Thank you. It really does work. It is an incredibly powerful tool. And it goes back to that statement I made. Wouldn't you rather know what you're dealing with than be guessing? Because you know what? If you know and it wasn't that good, you can fix it. If you don't know, it's going to hit you over the head at some very, very inappropriate time. And it is usually a severe cash flow problem. And trust me, in business, we've all lived through them. They are not fun. So, okay, we want to avoid that. I'm going to talk to you about KPIs. And we asked the question a little bit earlier about what the heck is a KPI. So then, we overly complicate this. We really do. So I want you to think of your business for a moment, and I want you to think of your clients. And for those of you who are pre-revenue, maybe your client at this moment in time are VC groups that you're pitching to. And I want you to ask the question, what is the most important thing that that client is going to expect from our business? And I am going to go around and ask everybody. So I'm going to give you a moment to think about that. There are no right or wrong answers. And while you're just going through thinking about that, I'll tell you a story to give you thinking time. Aren't I nice? What I'm going to ask you to do after you've thought about that is I'm going to ask you to think about the different people in your company, could be different departments. And I'm going to say, in order for you to achieve that overarching, what is it that my client expects most from me? Question. What do they have to do along the funnel? So in my old business, we had 3 revenue streams. I do practice what I preach. And those revenue streams were project work. We talked a bit about that earlier. It could go on for a year, 2 years. Maintenance work. Why did we add maintenance work? Because it gave me a reoccurring monthly revenue. So flattened out those peaks and valleys in my cash flow. And just the sale of components, non-value add. Why did we do that? Well, because we were national distributors anyway, because we needed to be competitive to bid the project work, so we have access to goods at a good price, so why won't we just sell? So, the 3 revenue streams that we manage. That revenue stream of just selling goods, so, you know, Rick, you want a mouse? I can sell you this fantastic mouse, it does all of this and the other at this price, I know what my gross profit margin is, I know I'm making money on this. So we decided that we wanted to track in that particular department what made it successful or not successful. So, you know, we just started looking at stuff, and then the first thing that we looked at is I said, okay, of all of the requests that we get for mice or whatever else, maybe we get 100 a week. How many do we fill? Well, lo and behold, we find we fill 70. Well, okay, so we fill 70 out of 100. That's not so bad, is it? What would happen to our profitability in that particular vertical if I filled 80% or 90% or 100% of all of these requests? And then on an intangible, what would happen to my customer retention if I filled 100% of your requests? Does that impact client churn? Because I've always said that a cancelled order is a cancelled account, right? So we determined that really very, very important in that department was filling more of them, improving our internal effectiveness in terms of selling whatever it was that we were selling. So we said, okay, what's the difference that makes the difference? So we determined by measuring a whole slew of different stuff that the difference that made the difference there was how quickly we filled it. So first of all, we looked at why were people buying X, and we discovered something really interesting, which we kind of knew instinctively, but we didn't know. And that is that the most of the people that came to us to buy whatever were in a down situation. So it was really time sensitive that they got this, so they got up and running really quickly. So we found out that if we could fill that request with this, immediately that the client went on our website, or if they were still old school and they picked up the phone and phoned us, or if they sent us an email, if we could fill that while they were in that process, then our ratio of internal effectiveness did go up to 100%. Now, isn't that interesting? Because when I asked the order desk department why they lost business, do you know what they told me? We're too expensive. You know what? Bullshit. It's because we didn't fill the orders fast enough. It is so easy to say we're too expensive as the catch-all, that if you dig deeper, then you might find it's something else. So what did we do? KPIs by department. So for that particular department, we're making a fun thing, not something you hit somebody over the head with. We had races as to who could fill orders fast enough. And on their dashboard, what came up for them all the time was the new orders they'd taken in that day, how many they'd filled. And we used to, send stuff out. We filled 120% of our orders coming in today. How does that happen? It's because there's a lifetime between what comes in and goes out. And that was the secret of success. So that KPI in that particular division radicalized our internal effectiveness and improved our revenue in that revenue stream by 30%. No shit. What does that mean for the people in the company? Bonuses, fun, all the rest of it. So that's my example of a KPI that makes a difference. So now I'm going to go back. You thought I'd forgotten, didn't you? So now I'm going to go back to y'all and I'm going to say, if you look at your enterprise overall, what is the key thing that your customer, whether they're an investor or whether they are a customer, expects from you? You've had enough time to think of it.
Yeah.
What is it?
Troubleshooting under budget within a very short time frame with zero emotional reaction. That's it.
Can you clip that down to something I can measure?
Hours spent,
Yeah.
like, I think it's a time difference between a problem that's raised and a problem that's fixed.
Okay, so you've got a time problem again, right? So what you want to do is you believe that the key thing you need to measure and focus on, because you know you get what you measure, right?
Yeah.
Is the time frame it takes from a potential conflict to a conflict resolution.
Yes.
All right, so that's your KPI. That's that simple. How much difference is that going to make to you if you just focus on it for once? Insane.
Same, yeah, it's the same, yeah.
Have you thought of that?
Yeah, I think for our customers, it'll be the product performance in the building envelope. So whatever they're replacing with our product, if it performs exactly like what they used to use.
So you're looking at a field trial situation?
Yeah.
So, okay, once you've put your product into the field, have you invoiced them by the time it's in the field?
We haven't done that yet. We have, we're yet to produce the quantity.
So you're looking at field trial ratios,
That's correct.
okay?
Yeah.
And so again, you're looking at a time frame, right?
Yeah,
Interesting.
Yeah.
So you've got some ideas about how to define that?
yes, yes, yeah.
What?
So like planning and preparation, which is definitely my time, and energy and that kind of thing. Yeah, I have several revenue stream ideas, and the food is kind of like one that I'm gonna be trying to add on, or more for compliance, for my clients. Thinking of like package deals in that sense, something package deals, that's more.
Let's you and I connect later, because that really is a bit different and it is complicated. Yeah, so I'd be pleased to do that. So you're talking about time allocation, so really.
Yeah.
You're talking about a resource, right? You are the resource.
Yes.
But you're talking about resource allocation. So that's your KPI. What percentage of that resource that happens to be you at the moment are you allocating? The common problem that we have as entrepreneurs, startup entrepreneurs, is that we don't spend enough time actually looking at that strategic part of the business and doing that stuff that makes the difference. So, okay, so I'm going to move over here.
All right, you people online, I've lost you all. So let me start, Erin, we've done you a lot of times. Carl, have you thought about a KPI that's going to make a difference? Has Carl abandoned me?
No, he
Carl,
has not. I'm right here. Sorry.
Okay,
Just,
Carl, have you thought of a KPI that'll make a difference?
I guess the one that is to me the most significant to customers is product that works
Right.
flawlessly. And so if we could measure months down the road, I presume, other than just upon delivery and testing, as you would know, but there's something there that would say, yeah, this is a quality product and it gave us no grief during startup, no grief during commissioning, and it was just a great experience. That keeps them coming back.
Okay, I love it. So you're talking there about process control post-sale. So you and I have talked a little bit, and we've not gone very far with it, but maybe we'll go a bit farther now, about perhaps looking at ISO, because that really is how you control that downstream functionality. But then for you, what you're identifying is that it's not a case of your point of sale that's an issue, but the functionality of what you've sold in the field for you've got to decide a period of time. So
Correct.
what you do is hang a matrix around that, find out what your current state is, and then look at goals as to how you're going to achieve it. So there you are. So let me have a look. Who else is there? Dave, I know that you guys are pre-revenue, but if you've got to think about something that's going to really make a difference with what you're doing, what would it be?
Yeah, so our I'll say our key performance indicators are environmental benefit, efficiency is significantly increased, safety is increased, and cost is reduced. So they're concepts at this point. Those concepts are going to have numbers put to them through a T analysis that we're organizing. So,
Yes.
so it's
Yes.
at this point, the key performance indicators, I think, are concepts, but we have a vision to put numbers to them to be able to say, here's exactly what it's going to mean to your business.
Yes.
In our sales proposition.
Yes. Okay. Thank you. Sugata, what about you guys? You're well into this now.
Yeah, so the golf space, they don't seem to care much about how much money they are saving, because whatever labor they get, they will continue to redeploy them in other activities which are more beneficial for their club. Instead, they ask us how many man hours or people hours can you offset? Like if the robot is running out there picking up the balls on a driving range, that person who would have otherwise had to do that job could be pushed to more fruitful, more productive activities on the range. They could be graduated. And that's been the key performance indicator. But we are also able to measure and give them exactly how many liters or gallons of fuel they saved, and by extension, how much carbon dioxide emissions offset is there. So all of this actually just convinces them more. Some of them just buy because of the cool factor. We realize that the cool factor vanishes after a while, so it has to function. It has to solve the problem. Yeah.
That's very interesting. So you understand what I'm getting at here. Your key performance indicators are just what is really important to your client. That's all it is. Don't pick too many. Pick the ones that are really important. There might only be one. And maybe this quarter it's going to be one. Maybe next quarter you're going to pick another. And then we talked a little bit about cascading that down through the organization and saying for the individuals working in your organization, what are their key performance metrics that dovetail into that corporate metrics that you're looking at. So these are some of the kind of things that you can measure. Gross profit margins. I am the profit margin queen. I mean, honest to God, I would not start a business that had less than 50% gross profit margin. And in my industry, 50% was about average, and I did used to run 65, just call me greedy. But you work just as hard, people, you work just as hard, make it easy on yourself. Net profit, obviously, revenue growth you might track. They're more financial KPIs. Customer-centric KPIs, cost of acquisition, customer retention rate, reoccurring revenues, customer experience ratings. These are in some cases more subjective, in some cases not, they're more quantifiable. Operational KPIs, your fill rate, your inventory turns. Some organizations look at their wages to revenue ratios. So these are really looking at those benchmarks that we talked about a little bit earlier about what will set you up as being the best in your industry sector. That's all that is. If you want to sort of think about this as to how you can use it, it's incredibly powerful tool, not just for your clients, your external stakeholders, but also for your internal, because it very much focuses your staff on the difference that makes the difference. You can tie that to all kinds of fun things. You can tie it to internal competitions. You can, reward people. I have a client in the blockchain business that has a development team which is overseas, and they have a domestic team in the US and in Canada. So having that geographic thing was a bit of a challenge in terms of keeping team all working together. And what we determined was, when we looked at where they were today and asked the $6 million question that you engineers in the room understand totally what is the problem we're trying to solve,
Their problem was they just simply didn't have enough revenue. So their ratios were pretty good. They couldn't cut anymore. They couldn't do this, couldn't do that. They didn't have enough revenue. So we instigated a program whereby everybody in the corporation looked at what they could do to encourage growth. So is that as simple as, for those forward-facing people that interact with the client every day, saying at the end of your conversation or your communication, can you refer me to somebody else in your organization I can help? What else can I help you with today? That simple. We instigated a KPI program that went right throughout all of the people, regardless of where they were geographically. And we upped their revenue by 35% in 9 months. What did we do? We focused on asking the customer, what else can we do for you today? And can you connect me with somebody else who I can think of? So that is the power of KPIs. And of course, you can change them, you can link them to compensation, all of that really neat stuff. So, the wild cards. What are the wild cards? Looking at your forecast. Is the economy going to tank? Have you got a new competitor into the shark's tank? Disruptive technologies. Is somebody kind of come in and just take it out of the water? Industry trends. Okay. And these really are where I always come back to, and I come back to this regardless of what the theme of our chat is about. The golden rules of being the best in class, right? Always budget for a profit. Certainly in some startup years, that's not going to be reasonable. But once you hit that magic break even, in other words, your net revenue or your gross profit is greater than your monthly burn, you really should continue to do so. So budget for a profit. Best in class companies, and this is across all industries, there are differences. Best in class is 20% on the bottom line. After everything's been paid for, 20% of your gross sales should be on the bottom line. I actually very rarely did that, but I used to do 15 very often. So it is very, very achievable. Rule number 2. Yeah, gross profit needs to be better than 50%. After you've paid to make your good or render your service, you have to have at least 50% of the sales left over to run your business, to pay yourself, for goodness sake, not from anything else. Best in class is 65%. If you start to look at SaaS operations, bankers, isn't that funny? Yeah, bankers. They are actually running gross profit margins up of around the 90-95%. Oh, ooh. Yeah, different industry, but for most of us, 65% is pretty. Invest in growth. One of the things I see over and over and over again is projections that look a little bit like a hockey stick. You know what I mean? Like it's going up exponentially from year to year to year. And I say, okay, what's driving that? And I look at their sales and marketing budget and what they're actually going to do to achieve that. And there isn't much of one. So then I say, well, this is wishful thinking. So make sure that you're investing in your growth. Otherwise, you're not going to realize those targets. So, all right. So I am a bit of a nerd when it comes to numbers, you might have noticed. One of the ways that I used to sometimes play around with my forecasts is I used to start with the premise that if nothing changes, everything remains the same. So next year is likely to be very similar to this year because there's no market conditions that have suddenly swung that are going to throw a wild card in there. And then I used to take my new or my incremental sales and marketing effort on a basis that to grow that, I needed to spend more. And I used to take an incremental rate of return off that additional spend. So you know your cost of acquisition and all of those good statistics and extrapolate that to my growth. So I actually used to drive my forecast off that sales and marketing budget line. It's actually quite an interesting way of doing it. We won't necessarily go down that path today, but that is one way of doing it. What I see over and over again, particularly in small businesses, owner-operated businesses, is I see a lovely website, nobody's seeing it. I see a lovely plan, but it's not being implemented. And when I do a deep dive as to why, it's because there's no money left over to actually drive the go-to-market strategy. So go-to-market strategy is great, but you have to have the budget as well to get there from here. So very important. Rule number 4, always price your product to make money. I see a lot of people who say, but you know, I have to be competitive. And yes, you do. But if your problem is that you can't produce your good at a price that you can be competitive against your competition, your problem is not price. Your problem is manufacturing systems and process. So you have got to be able to produce your good or service at a price that is both competitively and you can make money. So pricing in comes into that very, very critically. Obviously, on the little example I've got there, that assumes that there is no cost of goods sold. So if your burn is 10 grand and you're selling stuff at 100 grand, you need to sell 100 of them to break even. So it's very simple. Don't overcomplicate it. Rule number 5, budget to be the best in class. Budget for a growth minimum of 15%. For a gross profit minimum of 50%, and for a net profit of 20%. If you do that religiously, you're not just running your business, you're having fun. I told you I do a lot of work with people wanting to sell their businesses. There are 2 reasons people want to sell their business. They're coming up to retirement age, they have nobody in the family that wants to take it over, or the business is failing and they want to dump it. That's candidly what it is. So when I work with folks in that position, you will be amazed how many people at the end of a year or a couple of years that we've worked together, and I say to them, okay, your business is now ready to be sold. They say, we're having so much fun. I don't want to sell my business anymore. Happens quite a lot, you'd be amazed. All right, I think we're at the end. Yes. So we're back to this dude. He's not actually texting. He's checking his KPIs to make sure his business is on track. So that's it. That's my 2-minute tour of what you use numbers for. You use them to leverage the assets of your business, and you use them to be able to understand intimately, granularly how your business is doing. Why? So you can make changes. If it's not working right, change it. If it's working really well, do more of it. It's really simple. So that's it, guys. That's my chat. Questions? Do you know everything there is to know about it now? All right, it's a bit of a dum-dum, I know. It's kind of
digest.
I know it's kind of coming up you like a fire hose. So I invite all of you just to reach out to me personally. I think most of you know. So those of you that don't,
I think Dave might have a question.
oh,
Yeah. Hey, Judith, how are you?
I am good, Dave. Make it a good
Good.
one.
So pre-revenue, and in fact, pre-valuation.
Yes.
If we're putting this together, and our plan is, either licensing or purchase of IP, and we haven't yet done a proper T analysis to establish exactly what the valuation is.
Yes.
And do we just kind of go, okay, here's the vision and make shit up?
I wouldn't have phrased it that way, although I appreciate you using a technical term. At a certain moment in time, we're all going to guess, right? We're going to gaze into our crystal ball, which hopefully isn't broken down. We're going to pick a figure. Why are we going to do that? Because it gives us a baseline to measure from. The more that you measure from your baseline, the more that you're going to correct going forward, and the more accurate you're going to become. It's that whole thing about forecasting, right? When I said I'm going to make you check your actual to your forecast every month. So you might start with a figure that's really out there because you're taking your best stab at it. But then when you analyze the reality against your forecast, time in, time out, time in, time out, your reality becomes more and more accurate. So the other part of forecasting, when you do that correlation between your actual and your forecast, is to adjust your forecast going forward to better reflect the knowledge you now have. Because that's the whole idea. You become more knowledgeable through time as to what your enterprise is likely to look like. Okay. Okay. Any more for any more? I know it's a fire hose.
I just don't wanna know my financial statements right now. I don't wanna know it. It's so scary.
Pick on Rathy. No, I ask you though, Rathy, is it better to know so you can correct the issue,
Yeah.
or not know and it hits you over the head with a hammer?
It's better.
It's better. I'm just one of those people. Give me the good news, give me the bad news, but I want to know the facts. Because then you can create a plan.
Yeah.
So that's what it's all about. Be brave. Ta-da. My challenge to you. It's been great chatting with you all today. I hope I've been able to demystify this number thing. And hopefully the message you take away is it's not so much numbers as it is just tools to help you run your business. Okay, so little known fact about me. So I have a reputation for being a numbers person, and I am financially very literate. But you know what I really am? I'm a business and development person. And I use the numbers to drive the growth. And what gets me out of bed in the morning is new opportunity. And that's how I do the analysis around it. So frankly, I couldn't care less about spreadsheets and ratios and all the rest of it, that I do want to know if that's driving my business in the right direction. And that's what gives me joy. And that's what keeps me as an entrepreneur. There you go. All right, that's it.
Thank you, Judith.
My pleasure.